We're going to discuss when it is appropriate to adjust your trend lines. So in front of you is the Great British Pound traded against the Japanese yen on a 4-hour time frame, which means every candlestick represents 4 hours of trading. We're going to utilize this uptrend example to help us understand when it is time to readjust our trend lines. So let me first illustrate the concept so you thoroughly understand. When the market moves, the market typically will move in waves. It will make higher highs and higher lows on the way up. You bring in your hand-drawn trend lines to help you identify your long-term outer as well as your inner trend lines. But what happens when you bring in your inner trend line and the angle changes? How do you know when it's time to readjust your trend line? So for example, if this market is making higher highs and higher lows and you bring in your uptrend line across the lows of support, you can see very clearly the market is making lows on this uptrend line, which are optimal areas to buy the market. But sometimes the market has the ability to make a lower low but then reestablish the original trend and take out the previous high. How do you know when it is time to readjust your uptrend line and change the angle? So what I want to do is teach you a very simple set of rules. If by chance the market does break into the sell zone and enters below your uptrend line, what I want you to do is monitor the highest point of the trend. If you monitor the highest point in the trend, this can help you understand when it is time to readjust your trend line. So for example, this trend line is considered a broken trend line, and the market has the ability to reverse. And if you were to look at this uptrend line and you see that it's broken, you would look for opportunities to sell this market on the way down and look for a reversal. But if by chance the market provided a false reversal, the market will reestablish the original trend by simply taking out the highest point. So if the market by chance is able to reestablish a new high of the trend, that is the only time in which you would then readjust your trend. So let's take a look at this example inside of the live market. In front of you is the Great British Pound against the Japanese yen on a 4-hour time frame. And right away you can see, since the trend is already established, that the market has a long-term and an outer trend line that's been broken. When the outer trend line broke, the market started to make lower lows and lower highs and is heading towards the long-term trend line. But when the trend first established itself, and I am to zoom in at the original area where the trend established, at first when the market made higher highs and higher lows, I would bring in my hand-drawn trend line and place it across the lows of support. So I have a long-term as well as an outer trend line. But watch what happens when the market begins to trend. The market will begin to move, breaks my outer trend line, and heads towards my long-term trend line and where it found support. Let's see what takes place. Then the market begins to push bullish towards the north and make higher highs and higher lows. I can then establish or reposition my outer trend line, my long-term trend line, re-establish my new outer trend line. So notice how my original outer trend line is no longer relevant. I had to readjust my outer trend line simply because the market came back towards my long-term trend line. Let's keep going. The market makes higher highs and higher lows, breaks the outer trend line, and heads towards the long-term trend line once again. Finds support and then begins to push. So once again, my outer trend line is no longer relevant. Let's keep going. The market begins to push, and then look what happens. The market breaks and enters into my sell zone. Breaks below my long-term trend line. Now, I cannot readjust my long-term trend line unless the market is able to establish a new high, which means the market has to take out the highest point of this uptrend. Let's see what takes place. Notice how the market took out the highest point of the uptrend. This then gives me the ability to readjust my long-term trend line across the new lows of support. I will continue this process over and over and over again, and as many times as I possibly can, until the market reverses bearish. And if we were to continue to extend this and bring this to the live market, you can begin to see that the market is on its way back towards the long-term trend line. If by chance the market were to break my long-term trend line, I will have to approach the market as if it is reversing. So, for example, if the market were to fall bearish from where we are now and continue to make lower lows and lower highs, breaks my long-term upward trend line, I would have to approach this as if the market is reversing bearish. The only way in which I can readjust my upward trend line is if the market is able to rally all the way back up and take out this high of resistance or establish a new high price in the overall uptrend. And that would look something like this. Higher highs, higher lows, higher highs, higher lows, higher highs, takes out the highest point of the trend. And so now what I can do is readjust my uptrend line. Let's take a look at another uptrend example. In this example, we're going to utilize the Australian dollar trade against the US dollar on a 4-hour time frame. And you can see in this uptrend that we have already established the long-term trend line as well as the outer trend line. There's been several readjustments along the way, and hopefully you can begin to see them by now. But if not, we're going to walk through the process. It's very important to understand when it is time to readjust your long-term trend lines as well as your outer trend lines. So let's go ahead and get started. We're going to start from where the trend initiated all the way at the very bottom, at the very first low. When the market began to establish itself, it formed the extension, then the retracement, and then the market extended once again. Notice how the market has formed a high higher than the previous high and a low higher than the previous low. This is when we will begin to bring in our trend lines. You connect the lows of support and then you extend. If the market is able to break below this upward trend line, then we have a potential reversal. But if the market maintains its current speed and makes higher highs and higher lows, then we'll maintain its current angle. Now let's see what takes place. Market's making higher highs and higher lows. We can bring in an outer trend line, but I want to stay focused in on the long-term trend line for now. Notice how this market has a long-term trend line and the market has not touched it as of yet. Let's see if there's going to be a readjustment. Market maintains its position in the buy zone until now. Now, the fact that the market broke the upward trend line lets us know that there is a potential reversal, and we realistically should move forward with looking to sell this market or looking for counter trend line breaks bearish or even candlestick formations on the way down. In future lessons, you're going to learn about Fibonacci's, and Fibonacci can also really assist you in looking for great entry opportunities. But be that as it may, the only time in which we can readjust this angle is if by chance the market is able to make it all the way back up and establish a new high within the overall uptrend, which means that this market current uptrend angle stays exactly the same unless the market is able to break back into the buy zone, but not just break back into the buy zone, but take out this previous high. Let's see what takes place. Notice how this market was able to break back into the buy zone, rally all the way back up, and then establish a new high by taking out the previous high. Now, we do not have to the left and to the right as of yet, but the fact that we took out the previous high simply means the market is back in the uptrend and we are now making higher highs and higher lows. This is the time where you readjust your long-term trend line across the lows of support. You can also bring in inner trend lines moving forward, as well as utilize outer trend lines if the market adjusts. So let's see what takes place. You have your inner trend line as well as your long-term trend line. The market breaks the inner trend line, but in this scenario, it is the same exact process. You would not readjust your inner trend line unless the market is able to take out this previous high. Let's see what happens. Notice how the market took out this previous high. This would call for a readjustment. You continue this process over and over and over again until the market has a confirmed reversal. Now let's look at some examples, but inside of a downtrend. In front of you is the Australian dollar traded against the US dollar on a 4-hour time frame. And we're going to utilize this downtrend as the market is making lower lows and lower highs to help you understand when it is time to readjust your hand-drawn trend lines. First, let me walk you through an illustration of the concept of what we're trying to accomplish. Now, when the market moves, the market's going to move in waves. It will make lower lows and lower highs on the way down. And by now, you know that hand-drawn trend lines do a fantastic job with helping you identify future U-turns, as well as separating the market from a buy zone, sell zone. Now, in this scenario, the market is making lower lows and lower highs, and we have an overall downtrend. But what happens if the market rallies up, takes out the downtrend line, but does not reverse and falls back into the sell zone and starts making lower lows and lower highs. When it is at time to readjust your hand-drawn trend lines to across the highs of resistance. Let me walk you through this process right now. If by chance the market is able to break above your downtrend line, the only time in which we can readjust the downtrend line is if the market is able to reestablish a new low, which means the market has to break back below the downtrend line and make a lower low, lower than the lowest point of the current trend. So for example, notice how this market is above your downtrend line. If the market falls and takes out the lowest point of this trend, then that is the only time in which we can readjust your overall downtrend line. All that means is that the angle of lower lows and lower highs has changed. Let's take a look at the example of the downtrend. So in front of you is the Australian dollar, US dollar on a 4-hour time frame. And the market has already established the overall downtrend. And you can clearly see that we have a long-term trend as well as an outer trend. But this trend is a little mature, and as you can see that there's been multiple readjustments along the way. Let me walk you through those readjustments. We're going to start from where the trend initiated from, which is the highest point of the overall downtrend. Notice how this market started out making lower lows and lower highs. We've made a low with 2 to the left, to the right. We formed a high with 1, 2 candlesticks to the left and 1, 2 candlesticks to the right, lower than the central wick high. The market then fell and formed a low lower than this low. All this means is that the market is making lows lower than the previous lows, and the market is forming highs lower than the previous highs. This is when it is time to bring in your overall downtrend line and begin to start the process. I'm going to left click over the highest point of the trend, and I'm going to place my hand-drawn trend lines over the heights of resistance without breaking my overall candlestick wicks or candlestick bodies. If the market by chance breaks above my hand-drawn trend line, the only time in which I can readjust my hand-drawn trend line is if the market falls back below my downtrend line and it forms a lower low or establishes a new low point within the overall downtrend. Let me walk you through the process. Notice how this market is inside the buy zone, and you should treat this as if it's a potential reversal. But if by chance the market is able to fall towards the south and take out the lowest point, this is the time in which you need to readjust your hand-drawn trend line. Notice how I placed my hand-drawn trend line over the previous highs of the downtrend behind the lowest point. You will continue this process over and over and over again until the trend reverses or until you go to the live market. Let's see what takes place. Notice how this market broke the downtrend line one more time, entered into the buy zone, and you should approach this as a potential reversal. But if by chance the market is able to establish a new low within inside of the downtrend, this is the time in which you need to readjust your trend. Notice how you continue this process over and over and over again, and now you have your long-term trend line that's been established in the overall downtrend. This is when you can bring in your outer trend lines as well as your inner trend lines to assist you moving forward. Let's take a look at another downtrend example. In front of you is the Great British Pound trading against the New Zealand dollar on a 1-hour time frame. We're utilizing this downtrend as the market is making lower lows and lower highs. As you can see with this downtrend line, it makes it visually friendly with separating the market from a buy zone to a sell zone. But as you can see, there's been multiple adjustments along the way. Let me show you when it is appropriate to readjust your downtrend line. So we'll start out from the very top of the trend with finding the very first high of 2 candlesticks to the left and 2 candlesticks to the right, which are lower than the central wick high. Now the very first thing which we want to find is the market establishing a low with 2 candlesticks to the left and 2 candlesticks to the right, which are higher than central wick low. From there you want to find the high. Now what that basically means is this. You have a high lower than the previous high, and then you have a low lower than the previous low. This lets you know the market is making lower lows and lower highs, and the bears are in a downtrend or bringing the market down. You then bring in your hand-drawn trend line and rest it across the highs of resistance. Now, as long as the market stays below the downtrend line, you're going to maintain the overall short position. And as long as the market stays below it, you can continue to look to sell the market. If by chance the market does break and close above your downtrend line, then you need to approach the market as if it is potentially reversing. For this example, you can see the market has closed above your downtrend line. But you cannot readjust your trend line unless the market is able to establish a new lower low of the overall downtrend. What that basically means is this. This downtrend line will stay intact and cannot move unless the market comes down and takes out this previous low, which we have marked in the light blue line. If that happens, then we will readjust. Let's see what the market does. Notice how the market came all the way back down, entered back into the sell zone, took out the previous low and established a new low. Then and only then are we able to readjust the overall downtrend line, and now we have a very clear defined buy zone, sell zone, to where the market is making lower lows and lower highs at this particular angle. It is okay if the market does provide some false U-turns or false reversals along the way. Sometimes the market will not establish or present the angle which is U-turning the market until a couple false breaks. Once again, this was the Great British Pound trading against the New Zealand dollar on a 1 hour time frame. We have a long-term downtrend line which is clearly defining the market's buy zone, sell zone. The market is below the downtrend line, which means we are in the sell zone, which means it is optimal to look to enter the market short or selling the market. You can utilize down ABCD swings, Fibonacci's, which you're going to learn in the future lesson, as well as candlestick formation, which are really fantastic opportunities to enter into the market selling with avoiding drawdown and maximizing your return. Now remember, if the market is inside of a downtrend, making lower lows and lower highs and the bears are in control, you can bring in your down hand-drawn trend lines, which are a fantastic avenue to help you understand buy zone, sell zones. If by chance the market does break the downtrend line but does not reverse, it is very, very important that you do not readjust your trend line unless the market is able to establish a new low. This will help you stay focused and on trading true reversals when they do show up, and as well as helping you understand a false reversal when they do present themselves.